Okay, can you see the screen? I hope that you were able to see the screen, right? Hello, can you see the screen? Because I'm outside Google Meet, so I need to check that.
Yes, sir.
Yes, okay, nice. All right, chapter 2, yeah, which is financial analysis, yeah. Okay, so the word financial analysis, that means we need to look in the details by figures, and from the figures, we need to decide whether we made a good decision or we made a bad decision as far as financial management is concerned, eh. All right. So at the end of this chapter, you will be able to learn on the first one, introduction, what is the financial analysis is all about. And then the second one, there is a method we call as a financial ratios. Yeah, that means it's more on calculation part. Yeah, calculation part. All right, so let's have a look at the overview there. Financial analysis is very useful tool to analyze a firm's or business financial position. Okay, so the other advantages of financial analysis includes, okay, you see, if we break down into two words, okay, financial means that is more on money management. Yeah, so we want to analyze, are those companies having good money management or bad money management? All right. So the first one, the advantages is helpful in decision making because the report, the financial statement, the report that have been presented in the audit report is to provide an information. Yeah, that means we're talking about financial information. However, accountants, financial analysts cannot make instant decision because the most of the financial information which is raw or past data. That means, remember, we're talking about annual report. Okay, annual report, usually annual report reporting last year's performance. Let's say today is 2021. Therefore, the report which is past year, which is 2020 or 2019, the data is a past data. Yeah, that means it's already past. They are not reporting the present. Yeah, so therefore this ratio will help and guide users to make corrective action if there is a weaknesses in the firm. There is another one. If the firm have weaknesses, that means having a bad financial performance, the action need to be done by a company in order to improve and getting things around. Okay, so let's say they don't want, the company doesn't want to have losses every year. So that is one of the weaknesses. They need to have some preventive action on how to convert from losses to profit in the future. Okay, the second one, financial analysis is helpful in financial forecasting and planning. Okay, remember that the information given was past, past data. So therefore, it will help you to do some forecasting and planning. This one in chapter 3, yes. Okay, this one in chapter 3. I accidentally go for chapter 3 straight away without realizing that I need to lecture chapter 2 first. Yeah. So from the ratio analysis year by year, user will see the trend movement. Trend movement, which is it can be going up or it can be going down. Yeah, it depends. Each financial element have their own movements. Yeah. So therefore, it will be useful for users to predict the next trend movement. That means from the past data to predict for the future. And the last one, it is helpful for shareholders decision. Yeah, shareholders decision means that, remember the first chapter we're talking about the main objective of the company. The company is mostly belong to the major shareholder, not a manager, because their money, their capital, they injected the investment into a company. So, yeah, it is helpful for shareholders whereby the ratio will help them in leverage and profitability area. These are the area that mostly concerned by shareholders. Are the companies making profit or not? Are the companies having high debt or low debt? Yeah, we're talking about leverage, cost control. This one is chapter 7, leverage. Because it's their money. Thus, they want to see the progress of the firm to ensure the capital is used properly. Okay. So yeah, these are the most common method used by financial analysts or accountants to measure financial analysis. Yeah, we're using financial ratios. So there are four sections of financial ratios, which is four areas. Yeah, four areas of analysis area. Okay, so what are the areas? The first one, liquidity ratios. The second one, efficiency or activity. The third one, profitability. And the last one is leverage. Okay, let's see if I have some details on it. I think it's already almost similar as this one. Okay, so please, important matter is liquidity, efficiency, profitability, and leverage. So we need to look one by one. What does liquidity analyze? Yeah, what does efficiency analyze for? What is profitability analyze for? And what is leverage ratio analyze for? Okay, liquidity. Liquidity in Malay we call it as kecairan. Okay, kecairan or liquid. Yeah, okay. They took from word the liquid. Okay, the liquid. Usually when we learn in science, the liquid is a conversion from solid until to become liquid. Yeah, so that is a science method of liquid. Yeah, however in finance, the liquid is referring to, you see here, the ratio is used to indicate firm's ability to meet financial commitments. That means, are the company able to meet expenses every time? That means expenses, not only expenses but also some debts. Okay, so are this company able to pay expense daily commitments or debts? Yeah, I give you a personal example. For example, commitment. Me myself, yeah, I myself, I'm working, and then I got my salary, and I have a few commitments. For example, to pay loans, to pay credit card, and then to give money to wife. Probably another commitment is to give money to parents. Yeah, so these are the commitments. As far as companies' commitment, financial commitment is concerned, they need to pay worker salary. They need to pay some expenses, loans, debts, yeah, and so on. So the question is, are the firms able or not? If the firm is able to pay those things, yeah, to pay commitments, we can consider their liquidity is good. But if they are not able to pay, that means, yeah, the liquidity is not good at all. So these liquidity ratios, yeah, focuses on short-term commitment, yeah, which is within 1 year. Yeah, or we already talked about in chapter 1, yeah, current asset, current liabilities, yeah, and so on. Hence, these ratios are designed to give an indication of short-term cash flow crisis. The key of having better liquidity ratios is by looking at cash. Okay, that mean because sometimes they are saying that cash is king. With cash you can pay everything sometimes. Yeah. All right. So there are two formulas in this one. You see a current ratio and quick ratio. If you see the word ratio means that you in Malay we call it as nisbah. Yeah, that means in ratio, yeah, in English terms, sometimes you can call A ratios with B. That means you compare A with compare B. So therefore, later on you will see most of the ratios formula, yeah, are in divided. Okay, why? It is because they are comparing A value, they are comparing A value with B value. Yeah, so most of the formulas are divided. That means in the divide function. So for current ratio, the formula is total current asset divided by total current liabilities. Okay, so if good means that ability to commit, if bad that means inability to commit. Yeah, but for quick ratio or asset test ratio, that means total current asset minus inventory divided by total current liabilities. Okay, do not thinking too much because I'm only introducing the formula first. Later on we will do a study question. Yeah, we will use this formula and then I will demo you the calculation later on. Yeah. Understand the concept first. Liquidity means able to meet short-term financial commitments. Yeah, that is the first one. Okay, the second one, efficiency or activity ratios. Yeah, this ratio is used to see how efficient. Okay, you're talking about efficient. That means it is referring to company's operation. Are the company is very productive? Are the company is very efficient or not? Okay, so there are 5 ratios involved in efficiency there. The first one, average collection period. Okay, so average collection periods, the formula is account receivable multiplied by 360 divided by annual credit sale. Okay, you might asking why 360? Okay, usually 30 days, 30 days per month. Yeah, usually average 30 days per month. Therefore, your 12 months is equal to 12 multiplied by 30, which is 360 in a year. Yeah, we're talking about annual. Yeah, we are not doing exactly like 365 no. We usually have 360. That means 1 month is equal to 30 days. And then that means 12 months, which is equal to 360. Yeah, divided by annual credit sales. Yeah, so the answer will be in this. Okay, this is to measure the company's collection debt. Yeah, are they collecting fast or are they collecting slow? Okay, the second one is account receivable turnover. Okay, sales divided by account receivables. Okay, actually, you see, the word turnover means that they turn over the formula. Yeah, actually, the original formula is account receivable divided by sales. But because of the word turnover, they turn over the formula. Yeah, up and downs. So that's why we become turnover. Okay, so sales divided by account receivable. That means for 1 ringgit debtors, how much they generate the sales. Yeah, is it good or not? It depends. Yeah. Alright, the third one, inventory turnover, which is related to cost of goods sold divided by inventory. Yeah, okay. And then the next one, fixed asset turnover, sales divided by fixed asset, total fixed asset. And the last one, total asset turnover, which is sales divided by total assets. Yeah, so these are the formula related to efficiency or activity ratios. Okay, the third one, profitability ratios. Of course, the word profitability, which straight says it all. That means the ratio indicates company's rate of return and profitability performance. Yeah, to see whether the company is having good profit or bad profit. Bad profit in the sense of getting losses. Yeah, that can be compared across time and also be compared to other competitors and industry average. Yeah, so this is to measure the profitability performance. Okay, so those are the 5 ratios there. Gross profit, the margin, which is gross profit divided by sales. Operating profit margin, EBIT divided by sales. EBIT means that earnings before interest and taxes. Okay, the third one, net profit margin, net profit divided by sales. Return on asset, net profit divided by total asset. And the last one, return on equity, is net profit divided by total equity. Okay, as you can see here, the answer here is all in percentage, which means once you got the formula, you need to multiply by 100 for each. Okay, you need to multiply by 100 to get the desired answer of percentage. Yeah, usually, the better rate, the better performance it will be. Generally, rule of thumb says that better numbers, better answers shows that better performance. Yeah. The last one, leverage ratio, which is opposite from profitability. So this ratio is to measure the company's debt structure and ability to service the debt. This one we're talking about long-term debt. That means long-term loans, okay, which is loan more than 1 year. So debt ratio, the formula is total liabilities divided by total asset. Debt to equity ratio, long-term liability divided by total equity. Time interest earned, EBIT divided by interest. Okay, only this one in times, but this one in percentage. So you need to multiply by 100. Okay, one more thing, there is another formula on that ratio. You can use either one. You can use the first one or the second one also can. Okay, long-term liability divided by total asset. Okay, I can accept this one as well if you want to use this one, no problem. Yeah, okay, total liabilities means that current liability divided by, plus with long-term liability divided by total asset. This one also can. Okay, because as long as liabilities, we can consider as debt as well. Okay. I forget to mention one thing. Yeah, some of the ratios have asterisk symbol. For example, this one. and this one, it says that the lower the value, the better the performance. Okay, they have some reason. Yeah, they have some reason why lower the value, the better the performance. There are three ratios, if I'm not mistaken, and this one only. Straight means that the lower the number, the answer, the better it is. Yeah. Okay, so here are the example. Yeah, later on you will study. Yeah, if you have some time for self study. Yeah, these are the one because I'm gonna show you on how to answer that one. Yeah, doing live. Okay, open to any question.
No questions, sir.
Okay. Everything okay? Jenna okay, and then Jenna okay. Are you okay, Jenna? Aya, are you okay? Disha?
Yes, sir.
Okay, nice. Vivian, are you okay?
Okay, sir.
All right, good. Okay, so we take a 3 minutes break. After that, I will demo on how to answer that questions. 3 minutes. Okay, so let's move on to study question. I will show you on how to answer. Yeah. Okay, let's go for question number 3. I think question number 3 is the best. Best for basics. Okay, but before that, let Okay, so let's have a look at question 3. Okay, Nexus company is applying a loan from bank to finance its project. As a financial manager of the bank, you are required to evaluate the company's financial performance in comparison with the industry. That means you need to compare later on your company, which is Nexus, with the industry's performance. Yeah, to see are this Nexus company better than industry or not? Yeah. Okay, so below here is a financial information as at 2017. So they're giving you usually balance sheet and income statement. In the assignment later on, which I will brief to you probably by next week or next 2 weeks, yeah, you need to do the same thing as well. Yeah, some kind like this one. Yeah, to see whether you done the analysis right or wrong. Okay, so they given this one, balance sheet and income statement. First thing first, before you answering this question A and B, you need to understand the structure of balance sheet and income statement. Yeah. Alright, I repeat again. Yeah, you need to understand the structure of balance sheet and income statement before you answering those ratio. Okay, so this group, yeah, this group stands for current asset, yeah, which represent current asset, cash, marketable securities, account receivable, and inventory. All of these are current asset. Okay, net plant and equipment, this one is a fixed asset. Yeah, that means current asset plus fixed asset, it will become total asset. Alright, this group is more on current liabilities. Yeah, and this group, yeah, only one is more on long-term liabilities, and this group which more on equities. Yeah, so you understand the structure, because if you understand the structure, you can calculate easily. And then to understand the income statement structure, which is revenue minus cost of goods sold, become gross profit, less operating expenses, it will become EBIT, less interest, it will become earnings before tax, and then less tax will become net profit. Okay, and then they give you average industry ratio. Current quick debt ratio, time interest earned, average collection period, inventory turnover, net profit margin, and return on asset. Okay, question A. Calculate the indicated ratios for Nexus company. Okay, my question to you is, okay, we have 2 plus 5, 7, plus 5, 12, plus 3, 15, almost 16. Okay, my question, do we have to calculate all 15 or 16 ratio in the question? Do we have to or not?
No, sir.
No, because you only calculate whatever that they are asking here. Only it. Yeah, that means only selected ratio you need to calculate. Yeah, otherwise don't answer whichever not related to the question. Yeah, so you just be straightforward, answer whatever that you have here: current quick debt, in time interest earned, average collection period, inventory turnover, net profit margin, and return on asset. Okay, there is no issue if you answer quick ratio and then average collection period and then quick ratio. You can do horizontal or vertical way. Yeah,
So
no
can you
problem.
send us class link? Attendance link.
What is it? Sorry.
Attendance link.
Somebody please help. Yeah, somebody please help in the chat box. I'm teaching. Yeah. Later on, Yanisha, somebody will copy paste for you. Yeah. All right. Okay. You see, this one, as long as you have all these 8, should be no issues. Yeah. Okay. So let's answering question 2. Okay. So Okay, first thing first, yeah, to answer question A. Alright, calculate the indicator ratio. Okay, first thing first. Okay, the first ratio is, hold on a second. Okay, the first ratio is current ratio. Okay, so for current ratio, the formula will be, okay, so if these are the another tips to put the equation, fraction, these two. Current asset divided by current liability. You can put total current asset and total current liability also can, no problem. Yeah. Okay, so all right. So go back to the question. Okay, and yeah, fine. Yeah, where is the current asset first? Okay, current asset, as you can see, these are the group of current asset. Yes, so you need to add up everything that is related to current asset. Okay, 30,000 plus with 600,000 plus with 830,000 plus with 400,000. Okay, that is the first part. Okay, the second part is current liabilities. So this group consists of current liabilities. Okay, this group consists of current liabilities here. So what you have to do is add up everything. 460,000 plus with 270,000 plus with 150,000 plus with 200,000. Okay, done. Okay, so once you are done, yeah, if you want to calculate with details also can, or if you okay, you can go for the shortcut also, no problem. So 30,000 plus 600,000 plus 830 plus with 400,000. 1860. Divided by total current liabilities, yeah, down there, this one. 460,000 plus 270,000 plus 150,000 plus 200. Okay, done. So the answer is in times. Okay, how do you want to know whether the answer will be percentage, either the answer will be times? Look here. This one in times, so should be no problem. If this one is percentage, that means you need to calculate in percentage. Okay, so how many times? How many times? 186,000, yeah, and then divided by 1080,000. Take two decimal points only. Do not make it complicated by having 3 or 4. Just take two decimal points only. 0.72 times. Okay, that is the first ratio. Yeah, we still have another 7 to go. Okay, 7 to go. Okay, let's say I go for this one, quick ratio. So quick ratio formula is current asset minus inventory divided by current liabilities. We have current asset earlier. If you want to calculate again, yes, no problem. Or if you can take straight away here, also no problem. Yeah. All right. Because you already know that current asset at this side. Yeah. You already know that current asset at this side. Okay, so let's say I take it straight away 1860 minus inventory. Okay. Where do we want to find the inventory? Go back to the question. Okay. As you can see here, inventory. This is the inventory. 400,000. Yeah, so minus 400. Then divided by current liabilities is already there. Yeah, 1080,000. So you will get the answers of, if you press calculator, 1860,000 minus 400,000 divided by 1080,000. Okay, which is 2 decimal point 1.3. Okay, 5 times. Okay, so that is the second part, quick ratio. Okay, the third one, yeah, which is let's say I purposely go for this one, average collection period. Okay, there is nothing wrong for the arrangement as long as you answer all 8. Okay, if you refer back to the formula, average collection period will be account receivable multiplied by 360 divided by sales. That means sales, credit sales also same thing. Okay, you can take that. Okay. So account receivable multiplied by 360 divided by sales. Okay, where do we want to get account receivables? Go to the balance sheet and you can see this one, account receivables. Amount is 830,000. Multiply by 360 days. And then sales, okay, where do we want to get the sales? This one, revenue. The other name for revenue is sales. Okay, please bear in mind, the other name for revenue is sales, 8 million. Okay, so by using calculator, you will get the answer of 830,000 multiplied by 360 divided by 8 million, 37.35 days. Okay, how do I want to know whether it is days or times or percentage? Look back at the question paper and you see here. Yeah, average collection period. Okay, the next one, inventory turnover. Okay, for inventory turnover, the formula will be I already memorized the formula, so you can if you for you yourself you may refer back to the formula that I given to you. Divided by inventory. Okay, where do you want to get cost of goods sold? Okay, cost of goods sold. Please refer to income statement. This one, cost of goods. So here, 3,600,000. Ignore negative, ignore the negative sign because this is a negative means minus, so just ignore. Inventory, you can refer back up there to balance sheet. This one, inventory 400,000. Okay, the answer is in times. Click over. Okay, 3,600,000 divided by 400,000, 9 times. Okay. Right, next ratio will be debt ratio. Okay, because we done 4. Next we go for debt ratio. Oh, okay, again, debt ratio, if you look at the formula, I give you another formula earlier, right? Okay, you can use the first one or the second one. Okay, let's say I'm using the first one, total liabilities divided by total asset. Okay, so where do we want to get this total liabilities? Okay, remember in balance sheet, okay, this is a current liability. This one is a long-term liability. So therefore, total liability consists of everything here. Okay, this one is current liability. This one long-term liability. So you need to mix up. If you opted to choose total liability, so make sure you add up everything here. Okay. All right, let's say we have current liabilities up there earlier, this one. Or maybe I want to become a little bit hardworking, so I can put everything here. Say 0, 0, 0, 0. 0, 0, 0, 0. Sweet 200,000. Okay, don't forget to plus long-term liability as well. That's with this one long-term debt, 1 million. Okay, and then total asset. Okay, you see total asset, you don't have to add up everything because it's already here, total asset, which is 4 million. So the answer will be percentage. If you press calculator, 460000 plus 270000 plus 150000 plus 200,000 plus 1 million divided by 4 million. Oh, 52%, so you get that ratio 52%. Next ratio will be times interest earned. Okay, for times interest earned, the formula will be EBIT divided by interest. Okay, where do we want to get this EBIT and interest? Okay, it's easy. EBIT is here already, or the other name for EBIT is operating profit, 700,000. Divided by interest, interest is this one, 120,000. So this one in times as well. If you press calculator, 700,000 divided by 120,000, 5.80 times. Okay, so that is next part. Okay, next with the other two, yeah, which is net profit margin and return on asset. So net profit margin. Okay, so the formula for net profit margin will be net profit divided by sales multiplied by 100. Yeah, I just purposely put divided multiplied by 100, so the answer will be in percentage. Okay, where do we want to get those data? Net profit. Okay, have a look here. You see the net profit here? The net profit is located here, and then you get 440,000. Sales, yeah, I told you again that sales is equal to revenue, which is 8 million, and then multiply by 100. So you can get this answer of divided by 8 million, which is 5.5%. Okay, and the last ratio, yeah, which is return on asset. So the formula is net profit divided by total asset. Okay, bye-bye. Okay, so net profit, yeah, you can get from here, this one, net profit, income statement, 440,000. Total asset, we can get here, this one, total asset, 4 million, at the balance sheet, bye-bye. So you can get the answers of, if you press calculator, for 40000 divided by 4 million, multiplied by 100, so you get 11. Okay, so with all these 8 ratios calculated, therefore you already tackle question A. Yeah. Okay, so usually in this chapter, this in exam, we put it as a section C. Yeah, section C. So these are the answers there. Okay, open to question. Okay, open to question. Any question? No? Okay, how about the others? Everything good, eh? All right. Okay.
Good.
All right, nice. Okay, so next question, yeah. All right, you already done the calculation, so you need to evaluate the overall performance of the company according to liquidity, activity, profitability. Actually, this one doesn't matter because you have all these 8 ratios. Okay, so to make analysis precise and better, I'm suggest to you to develop a table, analysis table, to easy comparison between your answers and average industry. Okay, let me show you on how to do that. Okay, so question B, I start at the next page. Question B, evaluating financial performance. Right. Prepare a column of 4 and then the row of 9. I think it's 9. Right. Ratios, company, industry, performance. So, using this one. Right. You already have ratios, company, industry, and performance. 1, 2, 3, 4, 5, 6, 7, 8. It's supposed to be 8. Okay, so first thing first, yeah, what you have to do, you need to work column by column. It's made easier compared to row by row. Row by row is quite difficult, so you need to work column by column. Yeah. All right. Ratios. You need to copy down, yeah, from the question or from question A, your ratio, that you calculated. Okay, I give you this one. Current ratio, quick ratio. Just write down everything. Current ratio, and then what else we have? Average collection period, inventory turnover. The next is inventory turnover, done. Debt ratio times interest earned. And then we have then the next one, net profit margin, return on asset. Net profit margin, return on asset. Done already with this one. Okay, next for company. Okay, what do you have to do with the company is, okay, remember you analyzing company, right? So, which is you need to put your answers. Transfer your answers inside the table. Okay, let's say current ratio. You got the current ratio of 1.72 times. So, just transfer 1.72 times. Okay, next, quick ratio. You got the answer of quick ratio 1.35 times. Just put here. Average collection period. You got 37.35 days. Inventory turnover, 9 times. Debt ratio, 52%. Times interest earned, 5.83 times. Net profit margin, 5.5. Return on asset, 11. Okay, done with this part. Yeah. Now we are moving to industry. Okay, remember, yeah, you need to compare the company with industry. So how do you get this industry data? Look back at the question paper. You see here average industry ratios. Basically, you need to transfer the data into the table. Okay, current ratio. Do it one by one. Do not rush. Current ratio 2 times. Quick ratio 1.8 times. Average collection period. Find average collection period. It's here, this one, 40 days. Inventory turnover, this one, 7 times. Debt ratio, this one, 55%. Times interest earned, 5.8 times. Net profit margin, 6.5%. Return on asset, 19%. Okay. Before you go to performance, you need to remember what are the 3 ratios that says the lower the better performance. Okay, go back to the formula. Remember the asterisk sign? Okay, asterisk sign symbol means that the lower the value, the better the performance. So therefore, the ratios that related to asterisk one is average collection period and debt ratio. Yeah, which says that the lower the better. Otherwise, yeah, the other 6 ratios, the higher, I mean, if the company's value is more than industry, the better it will be. Okay, let's have a look at one by one. We have performance. The answer is either two, which is either good or either bad. Okay, let's have a look at current ratio. 1.72 times against 2 times. That means yours 1.72 is less than 2 times. Okay, which one? Is it good or bad?
Bad lah kan?
Okay, nice. Just put bad here. Right. How about this one? 1.35 and 1.8. Bad also, right? Okay,
Yes.
not good. Okay, this one, average collection period. Okay, this one asterisk, 37.35 days, less, which is quicker than 40 days. Good or bad?
Good.
Good. Yes, yeah, because remember, yeah, the average collection period says the company is collecting debt faster, 37 days compared to industry which take 40 days. Yeah, kutip utang lah, in Malay we call kutip utang, lagi faster. Okay, inventory turnover. Okay, this one is good because the value is more than this. Okay, debt ratio, hutang. Yeah, it means the debt. This company have 52% debt less than industry's 55%. So is it good or bad? Good lah, because less, you see, yeah, very less debt compared to industry. Okay, times interest earned 5.83 against 5.80. This one 5.80 supposed to be, so 0, which is good. Net profit margin is bad because less, yeah. Profit for industry is better. This one also bad. Okay, at the end of the day, there is a one thing that you need to conclude, which is overall performance. Okay, bad. Okay, you see, there are for bad 1, 2, 3, 4, and good as 4. This one is, we call it as there are 3 possibilities, either good, most of them are good, or either bad or average. Okay, average means that balance between bad and good. That means the amount of bad and the amount of good are same. In this case, 4 and 4. So we can call it as average. If more bad than good, that means the overall performance is bad. But if more good than bad, the majority of them are good, that means it's considered good. So in this case, we can call it as an average performance. So as you can see, you don't have to write anything more. Yeah, it's just like this. We can say that the company is performing average compared to industry. Okay, so of course, if you are the financial analyst, even me myself, I will look not only good. I don't care about the good because the good is good already. Usually, I'm looking at the bad side. Why? Because from the bad performance, the company will need to discuss and will need to take action on how to convert from bad into good. That is a financial analysis is all about. From identifying the good or bad performance and then make it far better. Yeah, bad become good. If good will become better. So these are the critical areas, need to be analyzed. Yeah, if you want to be financial analyst lah. I think Jenna have an experience already in this one because she works at the audit company. Alright, so done with the question 3 already, and then basically we are done with chapter 2. Okay, let's have a look at other questions. Some of the question might feel confusing, Okay, let's have a look one by one. Okay, have a look at question 4. Alright, this one have no issue because as you can see, they divided. This is current asset, fixed asset. Okay, however, fixed asset, okay, since this one is minus, so you need to minus first. It will become 1.4 million. So if that is related to fixed asset, then you need to calculate first, accumulate depreciation to get fixed asset. This one is current liabilities, long-term liabilities, and equities. Okay. Sales. This one they didn't put bracket, so you need to understand. minus profit before tax and tax minus. Okay, that is second one. Alright, so these are the ratios that you need to calculate. This one also same thing. However, I just purposely put bracket because accumulated depreciation assumed to be minus. This one minus this one plus this one, you get a fixed asset. Yeah. Okay, I don't think you have no issue in this one. Same, I mean that the ratios that you need to calculate. Okay. Even there is okay, this one should be no issues. Chartered enterprise. Okay, current liability, long-term liability, equity. All right, so here you see the word operating income. Okay, the word operating income, if you try to attempt question 2, operating income is have a same term as EBIT. Yeah, operating income have a same term as EBIT. This one minus, okay, EBIT. And the last one, okay, same thing, all right. Current asset, current liability, fixed asset, current liability, long-term liability, equity. This one is a income statement, ratio. Okay, as you can see, those questions have the same pattern. That means the process are similar. Yeah, the difference is the figure are different and the ratio asked in the question are different as well. Yeah. Okay, so it's basically on how to answer question on chapter